Imagine standing at the edge of the next decade with its opportunities and risks swirling before us. In the same decade that followed 2008, the winners were clear, disciplined assets that combined real value, resilience, and rhythm. Today, I'll share with you three such assets, cornerstones of a portfolio designed not for the noise of the moment, but for the compounding potential of the next 10 years. For the decade ahead, the structure of return expectations has shifted beneath our feet, but most portfolios are still positioned as if the past will repeat. That's the mistake. If you examine the forward return potential baked into equity valuations globally, you begin to see a stark imbalance. U.S. equities have become richly priced, not necessarily in an unsustainable way, but in a way that leaves limited room for error or upside. When price-to-earnings ratios are stretched into the 25 to 30 range and margins are at all-time highs, the future returns are mathematically constrained. That's not pessimism, it's arithmetic. Now contrast that with developed international equities. Here we have a blend of overlooked value and underappreciated growth potential. Many of these markets, especially across Europe and parts of Asia, are trading at forward earnings multiples closer to 13-15. That's a 40% discount to their American counterparts. The last time that kind of spread existed, the reversion that followed played out quietly but powerfully over the next 10 years. What most investors miss is that performance is not just a function of business growth, but of sentiment and capital flows. When something is priced for mediocrity and delivers stability or even moderate growth, the repricing can be meaningful. The other dynamic at play is currency. For over a decade, the U.S. dollar has been strong, supported by relatively higher interest rates and capital inflows. But that tide is beginning to turn. Central banks across the world are de-dollarizing in gradual, structural ways. If the dollar weakens over the next cycle, and there are many signals pointing in that direction, then owning assets in undervalued local currencies offers a tailwind. It's not just about the equities themselves, but the currency exposure embedded in them. That's the part most passive investors forget to analyze. Let's not ignore dividends either. In a world where yield is scarce and risk-free rates are declining again in real terms, the cash flow component of international equities becomes even more critical. Many developed market companies, particularly in sectors like utilities, industrials, and consumer goods, offer dividend yields that are 2-3 what's available in the U.S. When compounded over a decade, the reinvestment of dividends in lower volatility environments generates a meaningful portion of total return. That's the compounding edge. Quiet, boring, but powerful. Of course, the risks are not absent. Political fragmentation in Europe, demographic shifts in Japan, and regulatory volatility in emerging Asian markets. All of these are real, but risk in and of itself is not the enemy. Mispriced risk is. When you're being paid handsomely for taking on measured uncertainty, it's often worth stepping in. And right now, global investors are underallocated to international markets, not because of logic, but because of habit. Portfolio inertia has become a blind spot. This underexposure is setting the stage for a rebalancing of flows, especially from large institutions and sovereign wealth funds, many of which are reassessing their benchmarks and long-term assumptions. The question then becomes, do you want to be positioned ahead of that shift or after it? Because once that capital begins to flow, and it will, it doesn't trickle, it moves in waves, and those waves, when they hit undervalued assets, tend to lift returns faster than expected. You don't outperform over 10 years by chasing what worked in the last 10. You outperform by identifying what's mispriced what's misunderstood, and what's due for mean reversion. International equities, especially in developed markets with sound fiscal regimes and export-driven growth, offer that exact opportunity, not because they're exciting, but because they're ignored, and in investing, the ignored often become the outperformers. The mistake most investors make when entering a new decade is assuming that the forces of the past will remain in place. But structurally, we are entering an era that will be shaped by scarcity, of energy, of infrastructure capacity, of stability. The world is undergoing a massive reallocation of capital into real things. Roads, data centers, power grids, renewable generation, water systems, and logistics corridors. And it's not ideological, it's mathematical. Deferred maintenance, demographic shifts, climate adaptation, and technological demand have all collided to create the most capital-intensive decade in a century, and the assets that are tied to that reality, real assets, are positioned to outperform. For decades, the world lived under the illusion that you could digitize growth forever with minimal friction. That illusion is now unraveling. The more we digitize, the more physical infrastructure we need to support it, whether it's bandwidth, energy, cooling, or logistics. Data centers are not floating in the cloud. They're planted on real ground with real power loads. AI development isn't weightless, it's heavy. It demands semiconductors, cooling systems, land, and uninterrupted energy. These aren't tech sector issues, they're physical asset plays. The more digital the world becomes, the more valuable the physical underpinnings become. We're already seeing the early beneficiaries. Utilities, once thought of as dull, are now being repriced as essential growth infrastructure. Grid expansion, transmission upgrades, battery storage, and distributed energy resources are drawing investment from both public and private capital at unprecedented levels. The same is true in transportation and logistics. Supply chain fragmentation has triggered a realignment of global shipping lanes and the need for redundancy. Port upgrades, rail investments, and smart warehouse development are creating entirely new return streams that are uncorrelated with traditional market indices. And then there's housing and real estate, not speculative development, but income-generating, strategically located real estate aligned with demographic and industrial shifts. Industrial space is in high demand. Multifamily housing in supply-constrained regions with strong employment nodes is pricing in a decade of income growth. What these assets share is durability, not in the physical sense alone, but in their ability to deliver real inflation-adjusted returns while volatility reshapes the broader financial system. One of the most powerful shifts underway is the transition from financial assets to productive assets. Institutional investors, pension funds, endowments, sovereigns are increasing allocations to real assets not just for diversification, but because they understand where value will be created. These are not speculative trades. They are structural allocations being made on 10, 20, and 30-year timelines, and those who run that capital flow are likely to capture the early phase of repricing. On top of this, inflation, whether cyclical or structural, is not going away. Policymakers have made clear that strategic objectives now trump economic efficiency. That means higher spending, larger deficits, and more politically directed capital. In this environment, real assets offer a hedge. They are tethered to real-world pricing power. When water costs rise, when tolls increase, when rents climb, owners of the underlying infrastructure benefit directly. That is not abstract exposure. That is direct participation in the economy's most vital currents. Many investors still think about risk in outdated terms, volatility, beta, correlation matrices, but the deeper risk is owning things that look safe and are structurally impaired. Overpriced tech multiples, government bonds with negative real yields, overleveraged balance sheets. These are the quiet killers of long-term wealth. Real assets, on the other hand, provide something rare, asymmetry. The downside is limited by tangible value, while the upside is unlocked by capital flows, policy support, and scarcity. To build wealth over the next decade, the game is not just about compounding. It's about compounding in things that the world cannot do without. Energy, water, logistics, housing, bandwidth, these are not optional. They are foundational, and when the foundational becomes financially attractive, the rational investor doesn't hesitate. He reallocates, quietly and with conviction. What most people misunderstand about capital markets is that the public side, the stocks and bonds you see quoted daily, is only a fraction of the real investment landscape. Behind the veil of index tickers and ETF lies a larger, more strategic ecosystem where the most sophisticated capital allocators quietly operate. These are the private markets, private equity, private credit, venture, and structured capital solutions. And for those with a long enough time horizon, this is where the alpha is increasingly generated, not through speculation, but through structure, access, and discipline. In a world where public markets have been commoditized by passive flows and algorithmic liquidity, private markets offer something fundamentally different: control. Investors aren't just buying exposure to an idea. They are partnering with operators, directing strategy, adjusting capital structures, and engineering outcomes. This level of involvement doesn't just enhance return potential. It reduces the randomness. It introduces intention into an otherwise reactive financial environment. That difference is profound, especially when navigating uncertainty. Private equity, for example, is not about betting on growth. It's about taking control of operational levers, cost structure, pricing, capital efficiency, and pulling them over time. This is not a trade, it's a transformation. You start with a decent business and make it better. You enter at a reasonable multiple, apply leverage responsibly, expand margins, and exit at a premium. That cycle, repeated thousands of times across industries and geographies, has historically delivered returns well in excess of public equities, especially on a risk-adjusted basis. Private credit plays a similar role from the other side of the table. In a financial system where traditional banks are retreating due to regulatory constraints, the demand for non-bank lending has exploded. These are not high-risk loans. These are senior, secured, cash flow, underwritten credits to middle-market businesses with tangible assets and predictable revenue. And because the supply of capital is constrained, the pricing is attractive. Yields are often in the 8-12% range, with strong collateral and covenant protection. It's not about taking more risk, it's about taking risk that is better understood and better paid. There's also a structural dimension to this. The largest pools of institutional capital, pensions, endowments, insurance firms, are steadily increasing their allocations to private markets. Why? Because they understand that public markets are saturated, forward returns are compressed, and liquidity is an overrated virtue when you're managing perpetual capital. Illiquidity, in this context, is a feature, not a bug. It allows for longer time horizons, deeper due diligence, and insulation from short-term noise. And when capital behaves more rationally, it compounds more efficiently. The misperception is that private markets are inherently risky or opaque. But the data shows the opposite. Over long periods, the dispersion of outcomes in private markets is narrower than in public ones. Because the managers involved are more engaged, the incentives are better aligned, and the decisions are based on fundamentals rather than sentiment. The key is access. Not everyone can invest in the top quartile of private managers, but those who can should, because the difference between average and exceptional in private markets is dramatic and persistent. We're entering a decade where capital efficiency will matter more than capital abundance. The easy money is gone. Interest rates are no longer at zero. Valuations in public markets are high, and the path to returns is narrowing. In this environment, private markets offer not just higher return potential, but resilience. These are assets that don't market daily, that are insulated from volatility, and that generate real cash flows in real time. This is not a tactical move, it's a strategic reorientation, a shift from liquidity, chasing to value creating, from passive ownership to active stewardship, from reacting to planning. The future belongs to those who can operate in complexity and harvest return from the real economy, not from sentiment swings or liquidity surges, but from structured, long-duration investments in the engines of commerce themselves. That's what private markets allow, and over the next decade, that's where the edge will be found. There are moments in history when people realize the rules they were playing by no longer apply. In those moments, confidence in institutions wavers, paper assets become suspect, and capital begins to search, not for yield or growth, but for protection. That's where precious metals come in. They're not speculative instruments. They're not momentum trades. They're insurance. Insurance against the kinds of systemic risks that don't show up on earnings reports or economic forecasts until it's too late. Over the past few years, the quiet accumulation of gold by central banks tells you everything you need to know. They understand something that most retail investors overlook. When monetary credibility erodes, when geopolitical alliances fracture, and when debt burdens become unsustainable, the traditional tools of financial management stop working. What remains is trust, and trust has always had a physical form, one that can't be printed, hacked, or defaulted on. That form is metal. Gold and silver don't rely on the performance of a government, the solvency of a corporation, or the growth of an economy. Their value comes from scarcity, permanence, and the universal belief that in times of chaos they hold purchasing power. This is not theoretical. It has played out in every debt cycle, in every fiat regime transition, and in every inflationary blow-off. And while modern investors like to dismiss gold as archaic, the most powerful monetary authorities in the world are quietly increasing their reserves. That's not nostalgia, that's strategy. The structure of the current financial system is inherently fragile. With global debt to GDP ratios exceeding 330%, the ability to raise interest rates without triggering a cascade of insolvencies is constrained. At the same time, the political appetite for austerity is non-existent. That leaves one tool: monetary debasement. Whether through explicit quantitative easing or implicit financial repression, the purchasing power of fiat currencies is being sacrificed to preserve nominal stability. But nominal stability does not protect real wealth. Precious metals do. In an environment where real yields are negative, where currency wars are becoming normalized, and where geopolitical tail risks are escalating, the role of gold is not optional, it's foundational. It provides an anchor when the system untethers. It sits outside the credit system. It does not rely on the performance of other assets to deliver value. It simply is, and that property, being uncorrelated to financial assets and institutions, makes it uniquely valuable when other correlations collapse. Silver plays a different but complementary role. It carries more industrial utility, making it somewhat more volatile, but also more responsive during periods of monetary expansion tied to fiscal spending. As governments pursue infrastructure, heavy stimulus, silver benefits from both monetary debasement and industrial demand. It acts like gold with a growth kicker, but with more volatility. What's critical to understand is that precious metals are not about returns in the conventional sense. They are about the preservation of purchasing power across regimes. Their value is inversely proportional to confidence in paper systems. When trust in financial authorities is high, gold stagnates. But when that trust is questioned, gold rises, not because it has changed, but because the denominator has. The unit of account becomes unstable, and gold becomes the constant. Portfolios that ignore precious metals are effectively short confidence. That's fine when everything works, but when it doesn't, the drawdowns are severe and recovery is slow. By contrast, portfolios that allocate even a modest percentage to metals find themselves with liquidity, optionality, and stability when it matters most. You don't buy precious metals because you're pessimistic. You buy them because you're realistic, because you recognize that systems break, cycles turn, and assumptions fail. And when they do, the most valuable asset isn't the one with the highest return, it's the one that's still standing. That's what insurance means, not avoiding risk, but surviving it. Quietly, reliably, without counterparty. Most investors, whether they realize it or not, are speculating. They may believe they're diversified because they hold a basket of stocks or a blend of equities and bonds, but the reality is more sobering. They're making a concentrated bet on a single economic environment continue, in typically one of low inflation, steady growth, and accommodative policy. When that environment changes, the portfolios unravel. It's not because the assets were bad, it's because the design was flawed. Real diversification isn't about having more line items. It's about balancing across different drivers of return, growth, inflation, liquidity, and being prepared for what most investors fail to imagine. Speculation is seductive because it rewards people quickly and visibly when the conditions are right. In the last cycle, the combination of cheap money and asset inflation made almost everything go up. But that illusion of safety is what blindsides people. They begin to believe that volatility is the only risk, and that as long as markets are calm, all is well. They underestimate structural shifts, they overlook regime change, and they forget that the biggest financial disasters often unfold not because of bad luck, but because of concentration disguised as confidence. Strategic diversification is about designing a portfolio that doesn't rely on a single outcome. It acknowledges that we don't know the future with precision, that inflation could rise or fall, that growth could accelerate or contract, that geopolitical tensions could escalate or resolve. It accepts uncertainty not as a weakness, but as a fundamental truth. From that truth comes the imperative to hold assets that respond differently to different environment. SAS, it's that zig when others zag, that cushion drawdowns when others collapse, that preserve optionality in conditions that others fear. The right mix includes growth-oriented assets like equities, but not just in one geography or sector. It includes inflation-sensitive assets like real estate, commodities, and infrastructure. It includes deflation hedges like high-quality bonds or defensive currencies. and it includes crisis insurance, like gold or certain forms of volatility exposure that may sit dormant for years, then surge when everything else fails. Each piece plays a role. No single position dominates. No single narrative drives allocation. The power is in the balance. This kind of diversification isn't easy. It doesn't produce the best returns in any single year. It often underperforms in bull markets. But it survives, and more importantly, it compounds, because the biggest enemy of long-term wealth isn't underperformance, it's drawdowns. The math of recovery is unforgiving. Lose 50%, you need 100% to get back. Avoid the loss, and you don't need to chase. Strategic diversification protects against that asymmetry. It favors consistency over excitement. Another reason most investors fail to diversify meaningfully is psychological. There's a deep desire to believe in one narrative, to find the asset, the trade, the trend that will solve everything. That mindset is not just dangerous, it's expensive. Overconfidence in any single view, no matter how well supported, eventually collides with reality. And by the time it does, the damage is already done. What strategic diversification offers is resilience. It's the discipline to hold things that are out of favor because they serve a purpose. It's the humility to admit we don't know how the next decade will unfold. And it's the wisdom to recognize that survival is underrated. The world ahead is unlikely to resemble the past. Monetary policy is evolving, geopolitical alliances are shifting, and structural debt loads are rising. In such an environment, those who design their portfolios for robustness, not just returns, will come out ahead. Not because they predicted better, but because they prepared better. And in the long run, that preparation is what separates wealth preservation from wealth destruction. The goal isn't to be right every year. It's to stay in the game long enough for discipline and design to do what speculation never can: build something that lasts. As we stand on the threshold of a new decade, the question is not just what will outperform, but why it will. International equities, real assets, and private markets share attributes that transcend market cycles: inherent value, income generation, and tangible or structural foundations that will compound over 10 years. Today, I challenge you to look beyond the flashy but fleeting trends. Build your portfolio like an engineer, not a gambler. Anchor it in assets that deliver across environments, not just in the current moment. Because real growth, real resilience, and real returns are not found in the headlines. They're assembled thoughtfully, one asset at a time. Let's face the next decade not with hope, but with purpose. Thank you.